Okay, let's take a look at tutorial 3 question 2. So suppose there are only two risky stocks, A and B. So the first thing we need to highlight, there's only two risky stocks, which means we live in a world where this is the whole of the market. This just allows us to do some calculations, not overly complicated. So these stocks, we've got some shares outstanding. So this is shares that the company they've issued. So we know what's actually invested in these. We've got some prices for the stock and some risk rewards for each of the stock here. Risk and reward in terms of expected returns and the standard deviation. Okay, what other details do we have? We have the correlation coefficient is a quarter. There's also a risk-free asset that satisfies the CAPM exactly. Okay, great. Part A. What is the expected rate of return and standard deviation for the portfolios? So we want the expected rate of return for the portfolio and the standard deviation for the portfolio. Okay, so let's deal with part A first. So the first thing we need to figure out is the weights, the weightings invested in each of the stocks. Okay, so the total monetary amount invested in asset A, this is what we want, the monetary amount, not the number of shares. Well, there's 10,000 shares that have been issued for £6. So there's £60,000 that's been invested in A. And similarly in B, 30,000 shares have been issued at £4 per share, which is 120,000. So the total amount invested in the market is £180,000. And from this, we can see that the weight of A, well, this is 60 out of the 180, which is 1/3, and the amount invested in B must be 2/3. Okay, so we've got the weights, and we can see the expected return on the individual assets here. So we can put all this together to calculate the expected return on the portfolio. Well, it's the market portfolio, so maybe we should call it subscript M. So we have 1/3 invested in stock A, which has expected return of 15%, and 2/3 in B, expected return 12%. Add those up, it's the weighted average, and we get 13%. Okay, let's box that up, so we can find these numbers quite easy later. Okay, how about the variance on the market portfolio? Well, standard equation, hopefully straight from your mind, maybe with a quick reference to the formula sheet, should say that the risks associated with the individual assets are just up here. Okay, so drop them into the standard formula. 2/3, that should be squared, times 9%, 2 times omega A, omega B, times the covariance, which is the correlation coefficient times the product of the standard deviations. Okay, maybe I'll put a little note here. So this is the covariance between A and B, which is the correlation coefficient multiplied by the product of the standard deviations. Standard formula. Okay, this is a number crunching exercise. You will find that the market risk is approximately 8.718%. Okay, so this is standard calculation for a portfolio, small number of assets. The calculation is quite manageable. Okay, that completes part A. There's the risk reward on the portfolio. Part B, what are the betas of the stocks A and B? So these are the premiums, the multiples. Okay, so the CAPM model says that the premium on an asset I, in terms of its return relative to the risk-free return, should be some beta multiple of the market. The premium on the market, I should say. And the variance we know is proportional to the covariance, and the constant of proportionality is set up to be the beta value. Okay, so these are the two things that we know. Very important. Let's try lucky red. So we know these. Oops. Okay, so now we need to use these things. So it looks like we need the covariance over on the right hand side. Okay, so let's calculate so for asset A, the covariance on the market against the market return. Okay, let's calculate this. Well, we know the market return is the weighted average. And we know that those returns are constants. Okay, so using the linearity of the covariance, we can write this as omega A, the covariance of asset A plus omega B, the covariance of the return on A and the return on B. So this is just linearity. And we know the covariance of something against itself is by definition the variance. Everything else stays the same. And we have all these numbers. So in fact we have 1/3 of 15, I'll write them as decimals, percent squared, 2/3 times the covariance between asset A and B. We've already calculated this a moment ago. this is just by here. It's just this thing here. Okay, so a quarter, 0.15, 0.9. So 0.09. Okay, which gives, okay, again, a number crunching exercise, 0.00975. Okay, we're getting there. Okay, so we got that covariance. So next we need to, well, we can just calculate using the following. So the premium on acid A, just rearrange this equation up here. Okay, and again, it's just a number crunching exercise. I'm not sure if I have this calculation to hand. Let me just check. Yeah, I got it here. This is 1.2829. And similarly, I don't know how much room now. Oh yeah, I've left some room. That's great. Similarly for acid B, okay, so let's do it. Similarly for acid B, the covariance against the market again using the linearity. Oops. Is the covariance of the return on B, Okay, so the covariance of A and B, which we write as sigma. Okay, it's commutative, AB, BA, you can swap them around. And return on B, which is the standard deviation, squared, yeah, the variance. Okay, drop them all in. So we have 1/3 times, I think I can remember, is it 1/4 times 15% times 9%? I think that's right. Let's just check. Yeah, 1/4. Let's just by here. Yeah, that's fine. So plus 2/3 times the variance on acid B, which is 9% squared. So the covariance between acid B and the market in terms of expected returns. Okay, we're making some progress now. Is 0.006525, and so we can calculate the beta using our standard equation, which was boxed on the previous page, which is equal to, well, again, just some number crunching, which is equal to 0.8586. So there you go. They're the betas for acids A and acids B. Okay, this is a big calculation. So we've got those betas. Part C, what is the risk-free rate in the market? So the risk-free rate Well, it should be relatively obvious. We need to use the other equation, which contains the variable rf. Okay, so if we rearrange this for rf, okay, just a bit of playing around. Let's do it. So rf, we need to take them all to the one side. I think I'll use acid A, so I'll drop I equal to A. That will give, I believe, beta A, the market expected return, multiplied together, subtract the return on A divided by beta A take away 1, which means that the risk-free rate in the market, if we drop all those numbers in, okay, I leave it to you to write them all in. I'm just going to pop them straight to the calculator, and I know this is 0.05930 or 5.93%. Okay, that was a bit of work. Let's give it a colorful box. Actually, the others were quite hard work. Let's box them up. You can find them easier. That's beta of B. That's the beta of A. Okay, so we got the risk-free rate. Part D, what are the systematic and non-systematic risks for A and B? Okay, these are just standard equations. We've got so much data now, it's just dropping into the right place. So part D, the systematic risk. Systematic risk of assets A and B. We know from the lectures the standard equation is the beta value squared multiplied by the variance of the market, which are approximately, for asset A, 0.0125, and for asset B, 0.0056. So that's the systematic risk. So the non-systematic risk, we can see the light at the end of this question. It's the variance of the errors, which is given as follows. Standard equations, drop those numbers in. After the number crunching, you should get, for asset A, the non-systematic risk is 0.00999, and for asset B, 0.00250, and we're there. Okay, let's do better than the underline. Let's box them. Okay, so these are all the measures of the risk. And there you go, that was quite a bit of work. That's the complete answer to this question.